On the 5th of April, 2022, a single Luna token was worth $119. 5 weeks later, it traded for roughly 3/10,000ths of 1 cent, a fall of more than 99.99%. In the space of about a week, more than $40 billion in value simply ceased to exist. But Terra did not die because the market panicked. It died because its peg defense mechanism was, by design, a money printer that ran in reverse. Everything after the 7th of May was just the machine executing its own instructions. Start with what USD was. It was a stablecoin, a token engineered to always be worth exactly $1. But unlike its rivals, there were no dollars behind it. No cash, no treasuries, no vault. Its dollar peg was held together by code and by a sister token called Luna. The mechanism was a standing, protocol-guaranteed swap. You could always burn $1 of USD to mint $1 worth of Luna, and burn $1 of Luna to mint 1 USD, no matter what either token was trading for on the open market. In theory, this made the peg self-correcting. If USD slipped to 98 cents, an arbitrager could buy it cheap, burn it for a full dollar of Luna, and pocket the 2-cent spread. That buying pressure was supposed to push USD straight back to $1. On paper, riskless. The flaw was load-bearing. The arbitrage only works if Luna can absorb the burn. The peg was only ever as strong as the market value of the token you had to print to defend it, and that token's only real support was demand for USD itself. The collateral, in the end, was confidence. So why hold a dollar token that paid nothing? The answer was Anchor Protocol, Terra's flagship lending app, which advertised a near-fixed yield of 19.5% on USD deposits. At its peak, roughly 3/4 of all the USD in existence sat inside Anchor, doing nothing but farming that rate. That yield was not earned, it was subsidized. Borrower interest and staking rewards came nowhere near 20%. The gap was paid out of a reserve topped up by Terraform Labs. By April 2022, the protocol was bleeding an estimated $6 million a day to keep the illusion alive. Deposits chasing the yield vastly outran borrowing, the one activity that actually earned the protocol money. In February 2022, Terraform Labs injected $450 million of USD just to stop the reserve running dry. That was 3 months before the collapse. Terra's team knew the peg needed a real backstop, so the Luna Foundation Guard built one, a war chest of mostly Bitcoin that, on the eve of the crisis, held about 80,394 coins, worth billions of dollars. A truly algorithmic stablecoin should not have needed one. But this backstop was a correlation bomb. Bitcoin and USD were both crypto-risk assets that moved together. Selling billions in Bitcoin to defend the peg would push Bitcoin lower, feeding the very risk-off panic driving the run. The hedge and the exposure were the same trade. And there was one more detail only a trader would notice. The clean, on-chain swap was throttled. It could only absorb a few $100 million of redemptions per day before the fees to exit turned punishing. The peg's defense throughput was smaller than a real run. On Saturday, the 7th of May, Terraform Labs pulled $150 million of USD out of a key curve liquidity pool, thinning it ahead of a planned migration. About 13 minutes later, a single wallet swapped 85 million USD for another stable coin. Around the same time, large holders pulled 375 million more out of Anchor. Into that thinned liquidity, the selling landed with outsized force, and USD slipped below $1. This was not one mastermind attacker Forensic analysis points to several well-funded wallets heading for the exit at once. But the exit was far too narrow for the crowd trying to use it. The Luna Foundation Guard opened fire with its reserve, selling Bitcoin and stablecoins to buy USD and hold the line. On the 10th of May, it sold its last 33,206 Bitcoin. Within days, the reserve fell from over 80,000 coins to 313. The bazooka was empty, and the peg was still broken. Now the only exit left was the swap. Holders burned USD for $1 of Luna and sold that Luna immediately. Every burn minted new Luna. And as Luna's price collapsed, the protocol had to mint exponentially more of it to honor each single $1 redemption. This is the death spiral, and the arithmetic is merciless. Luna's supply exploded from roughly 1 billion tokens to more than 6 trillion in a matter of days. The peg defense mechanism had become a hyperinflation engine. Defending USD and destroying Luna were now the identical act. There was no way out. The only lever to clear the exit queue faster was to mint Luna faster, and minting faster only accelerated the collapse. For an uncollateralized stablecoin under a run on confidence, that is the fatal geometry. There is no interior solution. By Friday, the 13th of May, Luna was worth about 3/10,000ths of a dollar. Terraform Labs halted the Terra blockchain twice, because the flood of near-worthless Luna had made it cheap enough to buy up the votes and seize control of the network itself. At the center stood Kwon, Terra's co-founder, who had publicly mocked critics and sold the peg as self-healing. What the market did not know, Kwon had already co-founded an earlier algorithmic stablecoin that failed, and USD's celebrated recovery from a wobble in 2021 had been quietly propped up by an outside trading firm. The stability was staged, not mechanical. The blast radius was enormous. USD and Luna were collateral and counterparty exposure across the industry, and their collapse detonated a chain of failures. The hedge fund Three Arrows Capital and the lenders Celsius and Voyager over the following weeks. Terra was the first domino in the crypto credit collapse of 2022. Kwon was arrested in Montenegro in March 2023, traveling on a forged passport. He was extradited to the United States, pleaded guilty to fraud, and in December 2025 was sentenced to 15 years in prison. Terraform Labs settled with the Securities and Exchange Commission for more than $4.5 billion. The wreckage rewrote the rulebook. In the United States, new legislation now explicitly bans algorithmic stablecoins of Terra's kind and requires every dollar token to be backed one-to-one by cash or short-term government debt. Europe's framework converged on the same standard. Regulators had learned the lesson the machine taught. Terra's death spiral was never a tail risk. It was the design running in reverse. A 20% yield manufactured the demand, the Mintan burn module armed the loop, and the Bitcoin reserve was a correlated fig leaf with a hard bottom. When confidence cracked, the same arbitrage built to hold the dollar became the lever that minted 6 trillion tokens into nothing. The machine did exactly what it was built to do. This is capital autopsy. This is not financial advice.